My name is Fajasi. I'm the founder of StableBread, and in this video, I'm going to walk you through our automated stock analysis spreadsheet and how you can use it to analyze and value stocks faster and with more confidence. If you're someone who researches individual stocks, what exactly is your process for understanding and valuing a business? That depends on who you ask, but it practically always includes things like gathering and analyzing financial data across the income statement, balance sheet, and cash flow statement, calculating ratios and multiples to evaluate quality, profitability, and leverage, analyzing trends over time and creating charts to visualize them, and then comparing the company against its peers. Lastly, you usually build a valuation model or several valuation models to estimate what the company is actually worth. The point is that's repetitive for every new business you analyze, especially when the financials aren't standardized across different companies. So what if the analysis and valuation were already built for you? The financials, the ratios, the charts, the peer comparisons, all of it auto-populating the moment you type in a stock ticker. No building from scratch, no copy-pasting data, and it's all built inside Excel, the flexible and familiar environment you already know, so you can customize everything to fit your own process, unlike web-based stock research platforms. This spreadsheet includes models spanning the discounted cash flow, the dividend discount model, Graham's 3 valuation models, comparable company analysis, and residual earnings valuation. So this is what I spent the last few years building at StableBread, which is a value investing education site where we publish in-depth guides on stock analysis, valuation, and portfolio management. There's almost 500,000 words of content so far, and the spreadsheet is developed based on everything we've learned from producing all of these articles. The data side is powered by an Excel add-on called Wisesheets, which pulls stock financials, company info, and trading data directly into the spreadsheet, so everything stays live and up to date. So in this video, I'm going to show you how to get started and spend the majority of the time walking you through everything the spreadsheet has to offer. By the end, I'm confident that you'll be able to come to more quicker and more informed investment decisions. Before we even access the spreadsheet template, you need two things. The first is an account with Wisesheets, which is going to be where all of our data comes from. And if you scroll down to the pricing, you'll see that the pricing, in my opinion, is a no-brainer for what the product has to offer. So you can get started with even just $60 per year. The other thing you'll need is access to Microsoft 365 Excel. I recommend using the most up-to-date version of Microsoft Excel from the 365 subscription because that is what the spreadsheet was developed on. Once you have those two items, go to the automated stock analysis spreadsheet page, click on view options. You're going to get started for free. And then if you want access to more years and the quarterly data, as well as more customization options and the ability to edit existing sheets, then I would recommend the professional version. And then if you want the same access as I do, meaning access to edit and manipulate anything, then I recommend the developer plan. So just click on get access and then complete this form and you'll get access to the file. After you log into the customer dashboard, you'll see this download section. You'll probably only have access to the basic, professional, or developer version, just depending on whichever one that you got access to. So all you'd simply do is just click on that file. And then after the file is downloaded, you would just extract the zip file and then open it in Excel. After you open the Excel file, you'll see this cover tab, which includes important links for the automated stock analysis spreadsheet, including fully up-to-date written documentation. Below this, you'll see what version you're on and what you have access to. And then here is the guide, so you can read through this on your own if you're having any issues with getting started. Also recommend reading through these best practices here because I think they'll significantly improve your experience of using the spreadsheet and also the performance. Lastly, we have these self-formatting rules, and the main ones we need to focus on are the model input, which is this cell here with the yellow background, blue text, and gold borders, and then also this drop-down selection input cell, which is how all the drop-down formats are formatted across the workbook. Beyond those two cells, everything else is calculated automatically for you, and you don't need to edit any of these other cells in order for the spreadsheet to work. Now, the first tab is the Overview tab, and before we even get started with this Spreadsheet tab, you should make sure that Wisesheets is installed. So you can see here that it is installed, but if it isn't, you just click on Add-ins, search for Wisesheets, and then install it. And then just make sure you're logged in. One of the getting started requirements here is to also enable VB macros because that runs a lot of the formatting within the spreadsheet. So just make sure that is enabled. Once that's done, all you really need to do to update the spreadsheet is to enter a stock ticker here. So let's just type in NVIDIA. And as you can see, all the data updates instantly. And now let me walk you through the overview tab. The overview tab is where you configure the spreadsheet and get a high level snapshot of whatever company you're analyzing. So this top section here is where you'd configure pretty much everything that drives the model. So first here is the stock ticker. The ticker that you input here should match the Yahoo Finance ticker format. So for Microsoft, that would be MSFT. For Toyota on the Tokyo Exchange, that would be 7203.T, and so on for whatever company you're analyzing. And again, every time you change this, or even if you just go into the cell and click enter, it'll tell the model to refresh with that company's data. The next input cell is this analysis here. So this controls the last physical year displayed across the model, and you can go back up to 15 years from whatever year you selected. So Microsoft's last physical year is 2025 at the time of recording this video. By default, you should just keep that to 2025. But you'll see that you can go back as far as 2010. But if you set this to 2021, for example, you'll see that this turns yellow because it's not the last actual physical year for the company, but that also updates the last reported year across the entire workbook. You can see some of that taking effect here in this key financials tables here, where you can see that the last year being pulled across the workbook is 2021, and that's going back 15 years. But the best practice here is just to set that to 2025 or whatever the most recent analysis year is. And if you want to know what exactly that year is, you can just refer to this table here and it'll show the last physical year, and that last physical year date for Microsoft in this case is June 2025. If we change that to Johnson & Johnson, you'll see that the last physical year date is the end of the year. I would also check the cell after you enter a new stock ticker because, as I mentioned, different companies have different reporting years. The next option is the stock prices setting. So this controls how historical stock prices are pulled across the workbook. Physical year is the default, and what I recommend just leaving it at. It retrieves prices as of the company's physical year end date. So for Microsoft, again, that would be June 30th every single year. You can also set it to calendar year end, which retrieves prices as of December 31st or whatever the last trading day is of the year, regardless of when the physical year ends. The next drop down is the unit selector, which lets you toggle between how financial data is displayed, whether that's in billions, millions, or thousands. So that's purely a display preference, but for most companies, just leave it at millions. There's also a convert currency conversion toggle here, and you would use this if a company's stock price is in a different currency than its reported financials. If you turn this on to yes, which you don't need to do for Microsoft, but for a company like Alibaba, its price currencies are reported in USD, but the reported currency are in Chinese yuan. Turning this on, it converts the price currency to match the reporting currency across the entire workbook. This just makes sure that all of your price-based metrics, like the price to earnings and price to book, are calculated consistently and in one currency. The next cell here is the risk-free rate, and as you can see, this is just a pure input cell, and this is where you'd input the 10-year risk-free rate. So this gets used across the valuation models in the workbook. So I would just make sure that it is up to date, and you can use the data source link here if you don't know what that is. The next input here is purely cosmetic. It gives you the ability to switch between three themes, which is StableBread, the default, Wall Street, and Modern. And as you can see, once you click on it, the screen will flash, and then all of the charts across the workbook will have their formatting updated. Here's where you can input a date if you want to timestamp when you've last looked at the business. But moving on from there, we have the comparable section where you can input up to 6 comparable stock tickers. So these will populate this comps data backend tab over the last 3 physical years, as well as the trailing 12 months. And then you can compare those on the key financial statements and the key financial ratios tab, which we'll get into in a bit. And then also for a couple charts on the charts tab. So here I've got some already filled in here. I've got Amazon, Oracle, Google. We can add some more just for example. These aren't probably the best comparables for Microsoft, but it's just an example. So you'll see this data fills in. You can also do the price conversion thing here as well, and functions in an identical manner to how our currency conversion works here for Microsoft. So those are the most important inputs that drive the entire model. And then the rest of this spreadsheet on the overview tab is just the outputs of the model in a very summarized and condensed form. So first you have this stock price chart here that shows the cumulative percentage returns and the compound and the growth rate over a selectable time frame, anywhere from 1 month all the way up to the max. So that's the 5-year, for example, for Microsoft. And it also shows you the beginning date and the end date. Below that, you have a football field valuation chart. So here I've got it pre-filled in. This gives you a visual range of where the stock's implied value falls across different valuation approaches. This is a great quick glance way to see if the stock looks cheap or expensive relative to multiple methods. This should be completed after you complete one or more of the DCF, theoretical modelogram, or comps valuation approaches, and you simply input the low and the high estimate for that valuation approach. And then you can also input in the weights here in this column if you want to do a weighted average calculation, which weights those valuation approaches based on your confidence in them. Or you can do a simple average or median calculation here. And then we'll compare it to the stock price and tell you whether it's overvalued or undervalued. And then here is the key financial ratios section. So this is a condensed view of the most fundamental ratios, multiples, and metrics from the key financial ratios tab, which we'll get into in a bit. But it shows the last 2 fiscal years and the trailing 12 months. So you can quickly see things like the price to earnings, return on equity, debt to equity margins, and more without having to scroll through the full key financial ratios tab. And the metrics chosen here are the ones that I think are very fundamental to look at for most companies that you're analyzing. The last part of the overview tab is just a very condensed view of the 3 financial statements, which is pulled from our key financial statements tab here, which is just a collection of all the financial statements and supplementary calculations. So we have the income statement, balance sheet, and cash flow statement with corresponding charts, which are actually copied from the charts tab here. So if you customize anything there on the charts tab, which I'll show you how to do later, it'll also be reflected here. So within this section, you also have a compound annual growth rate period dropdown that calculates the compound annual growth rates for each of the line items here over a selectable range of up to 10 years. And then you also have a common size drop down that expresses each line item as a percentage of a base metric. So for the income statement and cash flow statement, that should be as a percentage of revenue. So you can choose any of these years here to compare against, as well as the trailing 12 months. And then for the balance sheet, you would do common size against the total assets. Now, if we look through the charts briefly, we have this first chart here, which is a stacked bar and line chart showing revenue, costs, and profitability lines. So you can see where the company is spending money and how margins are trending. And the second shows growth rates for revenue, gross profit, EBITDA, EBIT, and net income. The balance sheet summary has 2 tree map charts that show the composition of assets, liabilities, and equity. So these are useful for quickly understanding the company's financial structure at a glance. And then the cash flow statement summary has 2 charts as well. The first one gives you an overview of the operating, investing, and financing cash flows alongside capex and free cash flow. The second chart shows the historical cash position over time and how each of these cash flow activities has impacted liquidity. And in the final column here just shows the actual ending cash balance. So that is the entire overview tab. It's designed to be the first thing you look at when you pull up a new stock, just to give you a quick read on the company before you dive deeper into the rest of the model. Moving on to the key financial statements tab. So the key financial statements tab consolidates all 3 financial statements onto a single tab, the income statement, the balance sheet, and the cash flow statement. And then within each of the statements, there are additional supplementary items that are calculated below it. For example, I'm calculating daily operational expenses below the income statement. Now, in terms of data coverage, you get up to 15 years of annual data, which you can hide or show by using these grouped column buttons here. And you'll see that we have access to 2011 to 2025. You also have access to the quarterly data, specifically over the last 9 quarters here, which are hidden by default. You also have the ability to input the next 12-month estimates in this column. For example, if you had an estimate on market capitalization over the next 12 months, you just type it into here in the cell. There are a few features on this tab that make it more than just raw financial data. At the top, you can see that there are checkboxes that let you show or hide different sections. So if you want to only see the financial statements and you don't care about common size, growth analysis, or the per share metrics, you can just click on these checkboxes and then it uses VBA to just hide those sections for you. So now all you can see is the market data, the income statement, the balance sheet here, and then the cash flow statement here. And obviously you can select any one of these and it'll show or hide those sections. So here's the growth analysis. And then here is just the per share metrics, including things like earnings per share, for example. Each line item also has a very small sparkline chart next to it. So if you wanted to see the year-over-year trend for different line items, you can just take a quick glance at that as well. And these are useful for quickly spotting whether something like revenue or operating income is trending up or down without having to read through every number. One thing I want to mention for the per share metrics is that you can toggle between basic, diluted, or user-defined share counts. And that will just determine how these per share calculations are performed. If you select use your shares here, then just make sure to fill in this row here. And I just have that as an option because sometimes different companies have different practices for how they report basic or diluted shares outstanding, especially for international companies. And then for all of the comparable companies, in our case, the 5 companies that we inputted here, you can calculate those only on a basic or diluted shares basis. Now, one of the more powerful features of the workbook is the threshold pass-fail system. So for any metric, you can set a threshold, and then the spreadsheet will conditionally format it as a pass or fail. There are 3 checkbox columns, as you can see here, that control where the formatting applies. You select the checkbox on the left if we want to apply it to the company's financials. The next checkbox column is for the min, mean, median, or max statistical range, where you can select the beginning and ending periods here, and it'll show the calculations between that range. And then the last checkbox column here is for all of the comparables. So if you toggle this on or off, it applies the conditional formatting. You'll see that I have some pre-filled in here. I have 1.5 million for market cap with a pass. And then for net income, I have it filled in for both pass and fail. Anything above 100,000, it's flagging green because it's passing. Anything below 8,000 is flagging red because it's failing. Anything between that is going to be the yellow highlight. So you can apply these across every single metric or just leave it blank. That will help you analyze the financials, the per share, the growth analysis, and the column size a lot more efficiently. And if you're unsure whether higher or lower is better for a particular line item, you can always reference these up and down arrows here. So for example, for revenues, a higher number like 300,000 is always better than a lower number. So that would be the correct way to input that. And then on the contrary, for something like an expense, you'd want a lower number. You would input in something like $25,000 there and 30,000 there. So just make sure to input the right number where it belongs. Otherwise, the conditional formatting will come out to be confusing. Now, one thing you might have noticed here is this blue and red formatting here that is shown all the way down across the fiscal year 2025. And that is because for our comparables here, what it does is it calculates the average and median for every single line item. And then if you want to compare, for example, the market cap average for these 5 comparables, you can always just compare the number here to the number here. But if you wanted to make them more visually distinctive, you would just toggle this checkbox here as I've already done. Select which metric you want to compare it against, whether that's the average or the median, and then select the period you want to apply the conditional formatting to. We had 2025 enabled, but you can just select any of the last 3 fiscal years as well as the trailing 12 months, and you'll see that the conditional formatting here updates all the way down across all the rows, excluding any of the supplementary items. That's an explanation of the key financial statement. One important thing to keep in mind is that the KFS tab is the primary data source for everything in the workbook, and all the ratios, the charts, the valuation models, they all pull from this data source here. So this is the foundation that everything else is built on. Now let's move on to the key financial ratios or KFR tab. This tab calculates roughly 135 different ratios, multiples, and metrics. These are almost all derived from the key financial statements tab. So it has the same data coverage and as the next 12-month estimates. If you inputted that, it'll show up here in the calculations, as well as the full 15-year period. And then we have the correlated data here as well. We have the full name and the short names, just like we had in the key financial statements tab. And then we also have a column for showing all of the formulas, so you can see exactly how something is being calculated, and there's no hidden logic there. The font colors here are also meaningful. So green means the metric improved compared to the prior period, red means it declined, and then black means it's either neutral or not applicable. So you can scan down a column and get a quick feel on whether things are trending in the right direction without having to apply the threshold, pass, fail configurations here. So for example, example, if you look at the price to earnings ratio, a lower price to earning ratio is better because that means the company is trading at a cheaper price relative to its earnings. The first column here, 9.5, is black because that's the starting point of the data. So there's nothing to reference it against. Then it becomes red because it's worse than 9.5x. And then it turns green because it's better than 15.1x. And so on all the way until the end. And then you'll see that the trailing 12 months will be black because there's no previous trailing 12 months to compare against. Same for the quarterly financials. You'll see that the starting period is black, and then it follows the same formatting rules here across the quarterly data and then also the trailing 12 months data. This template is very consistent to the KFS tab. We have the same year-over-year sparkline charts here, and then also the same threshold pass-fail system, which they've pre-filled out some inputs here just to show you how it works. We have the same min, mean, median, max range here, and then also the same functionality with the comparables. And then at the very bottom, we have these quality scores here. And by default, when you load the spreadsheet, these will be filled in for you because these are predefined and are not really user dependent. They're just based on whatever the paper proposed as a pass or fail for that particular quality score. So let me briefly walk through each of these sections so you understand how the tab is organized. So it starts with the price multiples and the enterprise value multiples here. Price multiples tell you what you're paying per dollar of earnings, cash flow, book value, and so on. And then enterprise value multiples are the same thing, but on a capital structure neutral basis, which makes them more useful when comparing companies with different levels of debt. The price ratio section here also includes some gram specific ratios like price to net current asset value, price to gram number, and price to net working capital. So that ties back into the gram valuation tab here, which we'll cover later on. Next, we have returns, which cover how efficiently the company generates profits relative to the capital it has deployed. And next, we have margins, which give you profitability at every level from gross profit down to free cash flow, along with cost ratios like stock-based compensation, SG&A, R&D as a percentage of revenue. And these are repetitive with what is shown on the key financial statements, but I think these are the most useful ones to look at, so I included it here as well. Turnover and working capital measure how efficiently the company converts assets and working capital into revenue and cash, including the full cash conversion cycle breakdown. And then we have the operating efficiency section, which captures things like the degree of operating leverage and how cash generation compares to the asset base. The free cash flow section tells you how much of the company's earnings are converting into real cash and what yield you're getting at current prices. Capital allocation shows how much cash is being reinvested into the business versus available for distribution. Then we have dividends, which covers yields, payout ratios, and the sustainable growth rate. You'll notice for dividends that a lot of it is unavailable as the striped cells here show, and that's simply because those exact dividends aren't really required to be paid on the same date as the reported quarterly financial data, so you can't do an apples to apples comparison there. And then you have all of these incremental sections. So we have incremental returns, incremental margins, incremental capital efficiency. These are worth paying attention to because they measure the returns and margins on new capital being deployed, not just the existing base. So while something like return on invested capital tells you how well the company has done historically, if you instead look at the return on incremental invested capital, it tells you whether the returns on the new investments are getting better or worse. So this is a more forward-looking indicator on whether the business is improving or deteriorating. Moving on the leverage side, you have liquidity, capital structure, earnings and cash flow leverage, interest coverage, and then debt composition. Together, these tell you how the company is financed, whether it can meet its short and long-term obligations, and then how the debt is structured across the short, long-term, and leases. And then finally at the bottom, as we mentioned, are the quality scores. So starting from the Piotrowski F score, this scores the company from 0 to 9 on profitability, leverage, and efficiency. Next, we have 3 Altman Z scores. This estimates bankruptcy probability with modified versions for non-manufacturing and emerging market companies. The Benish M score is next. This flags potential earnings manipulation in both the 5 and 8 variable versions. So here you can see the formulas for all of those. And then finally, we have the slow on accrual ratios, which measure what proportion of earnings is driven by accruals versus actual cash, where lower is typically better. And then each score shows the components being calculated, but you can collapse those rows if you like. So between the KFS and the KFR tabs, you have a full view of the company's financials, ratios, and quality. And then everything after the spreadsheet builds on top of what these two tabs provide. Moving on to the charts tab. The charts tab has 36 pre-built charts and 14 custom chart slots. This gives you a visual layer on top of everything from the KFS and KFR tabs. The custom chart slots shown at the bottom here, which are only available to the paid plans, lets you build out whatever additional views you need for your own analysis process. Before I go through each of these charts, let me show you how the tab works, because there's some functionality here that makes it much more than just static visuals. First off, if you recall, we have this chart theming. The theming works across all of these charts here as well. So if you switch to Wall Street, for example, you'll see that all of the visuals here change pretty much instantly. We can see the full analysis period range. And then here we have a checkbox that will show or hide the data tables that are found below each of the charts. So if you click on this checkbox, or you can also individually show or hide these row groupings, you can effectively toggle any metric on or off, and the chart, the legend, and the title for most of the charts will update dynamically. For example, you may think that this income statement composition chart is too cluttered, and what you can do is simply check or uncheck these metrics here, and it'll update the chart here. We may not care about interest expense, other income, or income tax. Unselect all three of these, and you see that the chart here updates. Clearly, you can see that these charts are all dynamic, and you're not stuck with a fixed view. You can configure each chart to show exactly what you care about. By the way, this first section here is the financial statements section, and most of these charts are found on the overview tab here at the bottom. So as we mentioned before, if you update these charts here, they'll also be reflected on the overview tab. So in this case, what we did is we unchecked EBITDA growth, and you can see that it's also not found on this chart here because it's simply a copy of the chart on the charts tab. So now let me walk through all of the pre-built charts and give you a quick overview on what they tell you and how they can be useful for your analysis process. So this first section is the financial statements, which is where most people will start since it visualizes the core data from the KFS tab. We have the income statement composition, which again shows the revenue, costs, and profitability lines together, so you can see where the company incurs expenses relative to revenue and how margins are trending. If you want to dig into how fast these profitability measures are actually going, the income statement growth chart plots the year-over-year growth for revenue, gross profit, EBITDA, EBIT, and net income, so you can spot acceleration or deceleration. The next section here is for the balance sheet. So we have this balance sheet composition chart here, which lets you toggle between assets or liabilities and equity, and you can see how the composition changes over these last few years and the trailing 12 months. You also have these tree map charts here where you can select the period. So for example, you may want to see the composition in 2025 more closely. You can see that here, and the same case for the liabilities and equity side. On the cash flow side, cash flow breakdown gives the operating, investing, and financing cash flows alongside the capex and simple free cash flow, so you can see how the cash is being generated and spent. And then the ending cash balance tracks the company's cash position over time with indicators showing whether the net cash went up or down each period. Once you have a feel for the financials, the next section is valuations, which helps you start thinking about what the stock is worth. So we have the historical multiple and fair value charts here, which are side by side for a reason. The chart on the left plots any selectable multiple in this list here, like price to sales, price to earnings, EV to EBITDA. And then also it has a moving average, so you can see whether the stock is trading above or below its historical valuation range. So you can select anywhere between 1 year to 10 years and kind of see where the company's current or existing price to earnings ratio has been trading at relative to what it's been on an average period over the last 5 years in this case. The chart on the right lets us select a value driver like basic earnings per share, revenue per share, operating cash flow per share, free cash flow per share, and then you type in a multiplier and then compare that implied fair value range to where the stock is currently trading and where it has traded in the past. So in this case, you select the basic earnings per share because you selected price earnings here, and then maybe you think the multiplier should be around 25x, and then the chart here will update automatically. The free cash flow to the firm bridge and the free cash flow to equity bridge walk you step by step through how free cash flow to the firm and free cash flow to equity are calculated for a selectable year. So these are useful for pinpointing exactly what's helping or hurting cash flow generation. And then the final two charts for the evaluation section are these comparable scatter plots, which let you plot the company against its comparables as we input it on the overview tab on 2 dimensions. We have a multiple versus a quality / growth metric on one chart, and the other chart we have a quality versus a growth metric. So for example, here we have the price to free cash flow versus the return on invested capital, and on the other one we have return on equity versus revenue growth. So you can quickly see if you're overpaying or getting a discount relative to quality and the growth you're getting, and just make sure that these periods here are the same. Here you see that the KFS here is the trailing 12 months. That's because we selected the trailing 12 months period here. So just make sure that's also 2025 because that's what our KFR year is here. That's also what our analysis year here is as well. So you just want to make sure that the comparison period is apples to apples, which now it is. The next section is the returns and quality, which has some of the more analytical charts on the charts tab. So if you want to go deeper on returns specifically, the returns on capital versus the hurdle rate plots a selectable return metric like ROIC, cash return on invested capital, or return on tangible capital, and its incremental version like return on incremental invested capital against a hurdle rate you define. So in this case, I'm just saying 10% with a decomposition chart next to it. And this just shows the margin and capital efficiency drivers behind the return on invested capital because that is what's selected for the ROC metric. But if you select cash return on invested capital, you can see that breakdown here as well. Then there are a few charts focused on the quality of those returns. We have stock-based compensation dilution versus the share repurchases, which shows whether the company's buybacks are actually offsetting stock-based compensation. Free cash flow versus stock-based compensation adjusted free cash flow shows the real cash generation after accounting for the cost of stock-based compensation expense. Now, if you zoom out a little bit, we have the retained earnings versus value creation chart. What this does is it compares cumulative retained earnings to market value added. So you can see whether the management is creating or destroying value with the cash it keeps. And the neat thing is that you can select a base year here, and that will give you a different answer just depending on whatever base period here you selected. And then finally, we have the cash conversion cycle, which visualizes how days inventory outstanding, days sales outstanding, and days payable outstanding affect the cash conversion cycle. So you can track how efficiently the company is converting inventory and receivables into cash. From there, we have the capital allocation section, which covers how the company funds itself and also where it deploys capital. The first chart here is sources of financing, which shows the mix of internal cash flow, new debt, and new equity over time. So you can see how reliant the company is on external financing versus internal financing. The capital deployment chart here then shows a proportional allocation across R&D, SG&A, CapEx, buybacks, dividends, and acquisitions. So you can see where the company is spending its money over time. If one of these are not really relevant to whatever company you're looking at, maybe R&D doesn't really matter, then you just unselect it here. Again, because most of these charts here are fully dynamic. The remaining charts in this section are dividend and cash return focused. So we have free cash flow yield versus shareholder yield, and this compares the FCF yield to the combined buyback and dividend yield. So this is useful for assessing how much cash is actually being returned relative to market cap. And when the shareholder yield here is greater than the free cash flow yield, then the chart suggests that it is becoming dangerous. Next, we have a simple chart that compares the free cash flow per share to the dividends per share. So you can see the coverage buffer there. And then we have these dividend charts. So we have the dividends per share and the dividend yield. So you can see how that tracks over time. And then you can also see the basic earnings per share and the dividend pay ratio. And these are related because you can see how the earnings growth relates to the payout ratio commitment by the company. These two charts here are particularly useful to look at when completing the dividend discount model. The last pre-built section is leverage and liquidity, which covers the company's debt profile and ability to meet obligations. So we have a debt to capital chart to start, which tracks the company's leverage ratio over time with a moving average. Then we have net debt to EBITDA versus net debt to free cash flow, which compares two common leverage ratios side by side. Next, we have a composition chart, which breaks down the total debt by maturity and type. In this case, we have short-term debt, long-term debt, excluding leases, and then leases. And then we have the leverage versus cost of debt chart, which shows whether changes in leverage are impacting borrowing costs. On the solvency side, we have the solvency stress test, which compares the capex plus the interest expense against the operating cash flow to see if the company can comfortably cover its mandatory obligations. And then we have the liquidity coverage chart here, which stacks liquid assets against current liabilities for a short-term coverage view. And then finally, we have the user-defined sections. Again, these are only available for the paid plans, specifically the professional and developer versions. So you have here 12 custom chart slots where you can select any metric from the KFS or KFR tabs. So maybe we want to look at R&D expense. That will be plotted here instantly. And you can toggle between whether you want to see a line chart or a standard bar chart graph. And then we have these two comparison charts here where you can plot up to 3 different metrics across different axes as well. So here we have revenue and free cash flow as bar charts, and then return on invested capital as a line chart on the secondary axis. But we can also just push everything to the primary axis if you want. It just depends on whatever metric here you're looking at. And this chart here is the exact same thing, just giving you another chart to work with. The idea with these custom charts is that if there's something specific that you always want to track that isn't covered by the pre-built charts, you can just build it out here. And then you can also dig in deeper by using these annual growth rate and compound annual growth rate tables. You can type in any number of years here between 1 and 9 years, and it'll tell you the annual growth rate calculation as well as the compound annual growth rate calculation. And these checkboxes apply conditional formatting automatically so that it's easier to analyze. So that is the charts tab in a nutshell. And I would recommend talking through the checkboxes and inputting in your own metrics into the user defined charts section to make this charting page a lot more useful to your specific analysis process. Now we're moving on to the valuation side of the spreadsheet, starting with the 4 supporting models that feed into the main valuation tabs. So the first tab here is the owner's earnings tab, which is a concept popularized by Warren Buffett. The idea is simple. How much cash can a business actually return to its owners after maintaining its current operations? So the formula to follow here is just to take the cash from operations minus the maintenance capex. The tricky part here and why this tab even exists is because companies almost never disclose the split between maintenance capex and growth capex. Total capex is reported, but how much of that is just keeping the lights on versus expanding the business is usually left for you to figure out, and that really varies from company to company on the available information within the 10K annual reports. So this spreadsheet gives you 6 different methods to estimate the maintenance capex. The first method lets you input maintenance and growth capex directly. This is the most accurate approach, but only works if the company explicitly discloses the breakdown, which is rare. So in this case, you see that I have that 20,000 filled in for the last 3 fiscal years. The second method is the simple free cash flow calculation. So it's just taking the cash from operations and subtracting the total capex. This is conservative, but it's useful as a baseline. The third method lets you estimate the percentage split between maintenance and growth capex yourself. So if you think 60% of capex is maintenance and 40% is growth, or vice versa, you would just input it in here and the model does the rest. The fourth method uses depreciation and amortization as a proxy for maintenance capex. This one you may want to avoid since depreciation can be distorted by accounting policies and doesn't always reflect actual maintenance spending. The fifth and sixth methods are both based on Bruce Greenwald's approach, and they estimate the growth capex by looking at how much total capex is needed to support revenue growth, and then it subtracts that from the total capex to get maintenance capex. Difference between the two is that method 5 here uses a 5-year average capex to revenue ratio, while method 6 uses the current period ratio. And you can collapse this group here because we don't need to really see it, as the final owner earnings number here is only based on one of the last 3 fiscal years. And so this final owner's earnings number that you select, you can select the method and also the year as your sort of base year or your normalized owner's earning number. The final output here from this cell specifically feeds directly into the discounted cash flow tab as one of the forecast methods. So when you get to the DCF and you select owner earnings as your forecast method, this is where the number comes from. The next valuation input tab is the free cash flow to the firm tab, which forecasts free cash flow to the firm. This is one of the more involved tabs in the spreadsheet since it's where you build out your assumptions for how the company will perform going forward. The formula is shown here. It's just taking NOPAT, also known as earnings before interest after taxes, or EBIT, plus D&A minus capex minus the change in non-cash net working capital. But rather than giving you a single number output, this tab walks you through the entire buildup from revenue down to free cash for the firm with conservative base and optimistic scenarios for each assumption. So it starts with 6 years of historical data from the analysis here, and then let's say forecast up to 10 years into the future. The first step is usually to make an assumption on revenue. So you set growth rate assumptions across your 3 scenarios, and then almost everything in the model is driven by these revenue growth assumptions for your conservative base and optimistic case scenarios. So in this case, I just have 10, 15, and 20% for every single year, which is just an example. Then what you would do is you'd forecast the operating costs, and usually that would be as a percentage of revenue. Revenue minus all these costs gets you the operating income, and if you add back D&A, that gets you to EBITDA. If you apply a tax rate to operating income or EBIT, you get NOPAT, also known as EBIT. Now, for every forecastable line item, the model shows you a reference key with the last year, the 3-year average, and the 5-year average as reference points. So you're not guessing. You can always just have the historical context next to your actual forecast inputs here. So in this case, what I've done is I just referenced the 3-year average as what's going to drive these key line item inputs here. And you can see that that is being reflected. If you look at the forecast years here, you'll see that they're the same as what's being inputted here in these cells. Now, below the main free cash flow of the firm forecast, there are 2 supporting schedules. The first is the fixed asset schedule, which tracks and forecasts plant, property, and equipment. So it walks through beginning net PP&E plus CapEx to get the gross PP&E. And then if you subtract the depreciation and amortization, you get the ending net PP&E. So for forecasting D&A, you have 2 methods select between these dropdowns here. The first forecasts D&A as a percentage of beginning net PP&E, which works better when the company has recently changed its asset base or depreciation policies. The second uses the rate of depreciation relative to gross PP&E, which works better when the company has a stable asset composition and consistent depreciation methods. For forecasting CapEx, you also have 2 methods. The first forecasts CapEx as a percentage of beginning net PP&E. This makes sense for companies with regular maintenance and replacement cycles. The second uses the fixed asset turnover ratio to back into what gross PP&E needs to be given your revenue forecast, specifically the revenue forecast provided in this row here, not any of the conservative base or optimistic case scenarios. This one is better when you have a better understanding of revenue growth and where that might be the primary driver of asset needs. The second schedule is the non-cash net working capital, which forecasts the individual components of working capital, specifically those that are non-cash, as the name suggests. First, we have accounts receivable for current assets, which is forecasted using days sales outstanding. So you'd set a days sales outstanding assumption, and then the model calculates what accounts receivable needs to be given your revenue forecast. So an increasing DSO means the company is taking longer to collect payments, which is a negative signal. Inventory has 2 methods. We have the days inventory outstanding, and then we have inventory turns. Both get you to a similar place, just from different angles. Increasing days inventory outstanding or decreasing inventory turns means inventory is sitting longer, which ties up cash. And then on the current liability side is the accounts payable, which is forecasted using days payable outstanding. If days payable is increasing, that means the company is taking longer to pay suppliers, which helps cash flow in the short term by constraining supplier relationships. And then all of the remaining working capital items, like the other current assets, prepaid expenses, accrued liabilities, any of these other current liabilities that I didn't discuss, are forecasted as a percentage of revenue under the assumption that they grow proportionally with operations. The key thing to understand about this tab is that the change in non-cash net working capital directly impacts free cash flow of the firm, meaning an increase in working capital is a use of cash that reduces free cash flow, and a decrease is a source of cash that increases it. And then, as we mentioned, everything on this tab carries through to the discounted cash flow, specifically when you select free cash flow of the firm as a forecast method on the DCF tab. All 3 of these scenarios here that I have highlighted flows directly into the DCF valuation. The next tab is the WACC tab, or the weighted average cost of capital, which is the discount rate you use when you value the company's unlevered cash flows for the DCF. This formula is the weighted cost of debt after tax plus the weighted cost of preferred stock plus the weighted cost of equity, as shown in this formula here. Each component is weighted by its proportion of the company's total capital structure. So it starts with the market value weights, and the model calculates the market value of total debt, preferred stock, and equity. And then in the section here, it divides each by the total total to get the percentage weights. Most companies don't issue preferred stock, so that weight is usually 0. Market value equity is just the shares outstanding times the current stock price, which is what I have here filled in using a named range shortcut. And then total debt is just the sum of the short-term debt plus the long-term debt. And with the way Wisesheets outputs data, operating leases are included within the long-term debt from what I've seen. And then we have all of the cost of capital calculations. So we start with the cost of debt, and you have two methods that you can use here. The first is the synthetic rating approach, which is based on Professor Damodaran's work. It just takes the interest coverage ratio, which is calculated here, to estimate what credit rating the company would receive, which maps to a default spread table that is on Damodaran's website. So you can access that with this data source. You just add that spread to the risk-free rate, which we inputted, if you recall, on the overview tab at the top here. And that would give you the pre-tax cost of debt. So maybe we'd say it's 2%. The second method here is simpler, and there's nothing you have to do here. It's just taking the interest expense for the last fiscal year and dividing it by the total debt. This gives you a quick number, but it's less accurate since it doesn't account for varying maturities or risk profiles across different debt instruments. Whichever method you use, which you can select with this drop-down cell here, the model then applies a tax adjustment since interest payments are tax deductible. And the best practice here is to use a marginal tax rate, which currently is 21% for US companies. And I would recommend using marginal because the effective tax rate can be distorted by tax credits, deferred taxes, and other accounting items. So in this case, this gives us a 4.9% after-tax cost of debt. Cost of preferred stock is straightforward. It's just the preferred dividend per share divided by the current price of preferred stock plus a perpetual growth rate if the dividend is not fixed. There is no tax adjustment here because preferred dividends are not tax deductible. As we mentioned, most companies don't have preferred stock, so this section you'd usually just ignore and leave it blank. Finally, we have the cost of equity section, which is usually where you spend most of the time when computing a WACC. So the model uses the capital asset pricing model as the base, which is just the risk-free rate plus the levered beta times the equity risk premium. There's also a modified CAPM approach, which adds a country-specific risk premium, a size risk premium, and a company-specific risk premium on top of the standard CAPM formula. But if you start with beta, you have two options. The first is just to use the levered beta that is given by Wisesheets. The second is a bottom-up levered approach, which is usually more accurate because it takes betas from comparable companies, unlevers them to isolate pure business risk, and then relevers it based on the target company's capital structure. If you don't want to do that manually, the model also references Damodaran's beta's best actor page, which is accessible with this link as a shortcut. So you can just use the data source and then relever the beta for whatever industry you're looking at and just input that number in here. The next input is the equity risk premium. So that's the additional return investors expect for holding stocks over risk-free investments. Damodaran calculates an implied equity risk premium for US stocks, and the model references this. Now, these additional risk premiums on a modified CAPM are optional and more subjective, but can be important depending on the company. The country-specific risk premium applies to companies operating in countries with higher political, economic, or currency risk, or even those that have significant operations outside of where they're domiciled. The size risk premium compensates for the additional risk of smaller companies, and then the company-specific risk premium captures unique risks not reflected in beta, things like customer concentration, key person dependency, or regulatory uncertainty. This is, I would argue, the most subjective of all the risk premiums because based purely on your understanding of the business. Either way, you'll have the CAPM calculated here as well as the modified CAPM. And then at the bottom, you have a summary of the returns, debt, preferred stock, and equity investors are expecting for investing in this company, and then also the market value weights of each of those capital sources. And then the WACC here is what you'll reference on the discount cash flow tab when discounting unlevered free cash flow of the firm. And so there's the formula for that. The final valuation input tab is the dividend growth analysis tab, or just DGA for short. It's specifically made for dividend investors and those who are going to use a dividend discount model to value stocks. It analyzes historical dividends and earnings to help you estimate a sustainable dividend growth rate, which is the key input for the dividend discount model on the DDM tab here. So these sections are collapsible if you want to show or hide them. But starting from the top, we have the data that's required in order to complete these calculations. And it starts with the return on equity DuPont analysis, which is a pretty common way to break down return on equity into three drivers: net income, asset turnover, and the equity multiplier. This is useful because it tells you whether ROE is being driven by profitability, efficiency, or leverage. Put simply, a company with high ROE driven mostly by leverage is a very different situation than one one driven by strong margins. And you'll see that the model calculates the dividend pay ratio and the return on equity across the last 10 fiscal years, which feeds into the 3 sustainable growth rate formulas directly below the ROE DuPont analysis. So the standard sustainable growth rate is calculated as return on equity times 1 minus the pay ratio. The logic here is simple, as the more a company earns on its equity, the more it retains and the faster it can grow sustainably. That formula doesn't account for buybacks, which is why there are 2 augmented versions here. The first augmented sustainable growth rate, it adds back stock buybacks to the payout ratio. And so what you're doing is you're capturing total shareholder distributions, not just dividends. And then it just calculates the sustainable growth rate using that updated dividend payout ratio. The second augmented ratio goes a step further and also subtracts new long-term debt issued from that total. This matters if you believe the company is funding buybacks with debt, as this can overstate how sustainable the level of distribution actually is. The augmented sustainable growth rate here is just the same formula, but it's referencing the second augmented dividend pay ratio here. Lastly, at the bottom, you have these 2 growth rate analysis sections. The average growth rate analysis shows average dividend per share growth rate across rolling periods from 1 year to 9 years with average and median summary rows. The conditional formatting here highlights the magnitude so you can quickly assess which periods had stronger or weaker growth. The compound annual growth rate analysis does the same thing, but is usually more useful because it's using compound annual growth rates instead of simple averages. And as you can see, it has the same layout and same conditional formatting. Altogether, this tab should give you a pretty good idea of historical growth rates, where future growth rates are headed for the company's dividends and earnings per share, which go hand in hand when building out a dividend discount model. And this should help you determine a more accurate perpetual dividend and earnings per share growth rate when you finally complete the dividend discount model, as this is one of the most important but sensitive inputs. Now let's start talking about the actual valuation models. So the first tab is the discounted cash flow, or DCF tab. It forecasts these cash flows, discounts it back to present value using the discount rate here to get to the present value, and then it outputs an implied share price. So going into that more in depth, at the top you have the configuration inputs. The first is the forecast period, which you can set anywhere between 1 to 10 years, and you can see that the forecast updates automatically. For a company that's slow growth in a highly competitive industry, you might only want to forecast 1 to 3 years. A solid company with durable advantages, maybe 5 years, and then a high growth company with a more uncertain future outlook and its expectancy for when growth will eventually slow or normalize is more further out than a mature company. You would model out 10 years. Next, you select your forecast method. So we mentioned that free cash flow firm pulls directly from the free cash flow tab with all 3 scenarios. Owner's earnings pulls from the owner's earnings tab, and you can input in the growth rate assumptions for conservative base and optimistic cases right here on the DCF. And then diluted earnings per share uses the last fiscal year's diluted earnings per share as the starting point. This is less accurate since it includes non-cash items and doesn't reflect actual capex or working capital changes, but it's useful for a quick screening or when free cash flows are negative. The next step is to choose your terminal value method, which estimates the value of all cash flows beyond your forecast period. So you have 2 options here. The first is the perpetual growth method, and this assumes that cash flows grow at a stable rate forever after the end of the explicit forecast period, which in our setting is 10 years. So that is shown here, and this rate has to stay at or below the nominal growth rate of the economy in which the company resides and or in which the company does business, and it has to be below the discount rate of 10% as well. This growth rate can be negative if you think the business is in structural decline, and if growth rate is too high, you'll have a visual indicator here that will tell you no. The other method is the exit multiple method, and this applies a market-based multiple to the terminal year's financial metric. So you can choose from EV to EBITDA, EV to EBIT, EV to revenue, or EV to free cash for the firm, depending on what's most appropriate for the company. One thing to note here for the exit multiple method is that it is not compatible with the owner's earnings or the diluted earnings per share options here. It's only relevant for free cash for the firm, since these terminal metrics here that are shown in this highlighter range are sourced from the free cash for the firm tab for whatever year you're forecasting up to. The model also gives you cross checks between the 2 methods. So if you use the exit multiple method, it calculates the implied perpetual growth rate. If you use the perpetual growth rate method, it calculates the implied exit multiple. And so you simply compare the multiple here to the output here, the growth rates inputs here to the growth rate input here. If either of those look unreasonable compared to the other, that's a signal to potentially revisit your assumptions. And these adjust for mid-year calculations automatically. For the discount rate, the appropriate choice depends on your forecast method. If you're forecasting free cash for the firm, you would usually just use the WACC, so you can use that shortcut since those are unlevered cash flows that belong to all capital providers. If you're forecasting owner's earnings or delivered earnings per share, you would use the CAPM or the modified CAPM since those are technically already levered cash flows that belong to equity holders. Some investors also like to use the risk-free rate, which is RF_rate_ 10-year, and that way you can value the business sort of like at a benchmark rate. You can also just input in your own personal required rate of return, so the rate at which you want the future cash flows to grow at in order for the business to be considered worth buying for you and whatever goals you have set for your investment portfolio. The model also supports mid-year convention and stub period. As I've been walking you through this model, you've seen that both of these are enabled. You can enable one or the other, and the model will tweak how it discounts future cash flows. By default, the model assumes cash flows arrive at the end of each fiscal year. If you enable mid-year convention here, it shifts that to the midpoint of each year, which results in a slightly higher valuation since you're discounting over a shorter period. This is generally more realistic for many companies since cash flows are generated throughout the year, not all at once at the fiscal year end. And then if you turn that off just for now and enable just stub periods, you'll see that stub periods adjust for when your valuation date, which I'm just saying is today, falls partway through the first forecast year. So just make sure to input the valuation date here, enable stub periods, and then the model will calculate the fraction of the year remaining and adjust both the first year's cash flow and all the discount periods accordingly. So in this case, it's saying 72.6% because the next fiscal year is in about 3 months. You can enable both mid-year convention and stub periods, which is the recommended approach for most companies. And you can see that the discounting here is applying the mid-year convention and the stub periods to the forecast. And that provides the most technically accurate approach to discount future cash flows. That also affects the terminal value discount period calculations here. And that will vary depending on whether you select between the exit multiple method and the perpetual growth method. You'll see that the discount period number changes here. And if you want to know how that works more, you can always just reference our documentation. Now for the outputs, the first thing to understand with the outputs is that the implied share price for the conservative based and optimistic case depends on your forecast method. So starting with free cash for the firm, the model outputs an implied enterprise value. And then what you have to do is to bridge to equity value by adding cash and equivalents and other short-term investments, adding any other non-operating assets, which is a manual input if there are any, and then subtracting total debt and any other non-equity claims. Doing that will get you to the implied equity value. And then if you divide by the shares outstanding for the company, you get to the company's implied share price. And you have options here to select between the last fiscal year's basic 22 months, or you can also use the diluted shares outstanding as well, just giving you some more options there in terms of calculating the per share prices. Now, if you look at owner's earnings, there's no bridge needed because these cash flows already belong to equity holders. So the sum of these discounted values is just your implied equity value. So again, you just divide by the shares outstanding and you get to the implied share price. Finally, for diluted earnings per share, the output is already on a per share basis. So the sum of these discounted values here is already your implied share price directly. So you don't have to divide by the shares outstanding. And you'll see that as you change between the different options, different sections of the model will gray out, indicating what to ignore and what to pay attention to. The next thing I want to focus on is this chart that shows how the discounted cash flows grow over the projection period and through the terminal year. Again, these are the discounted values. And then these three values here show what percentage of the total implied value comes from the terminal value versus the forecast period cash flows across all three scenarios. So here it's showing anywhere between 55 to 67%. You would look at this to assess whether the terminal value is reasonable. If terminal value is something like 90% of total value, that's probably a sign that you're heavily dependent on long-term assumptions, which may be fine for a very mature company, but would maybe not make a lot of sense for an early stage growth company. Now, if you look back under the model, the formula outputs, we have a margin of safety input cell. So you apply a margin of safety to account for uncertainties in the valuation that you cannot reasonably estimate. After applying the margin of safety, you get the buy price ranges. If the buy price is above the current stock price, the stock looks undervalued. If below, overvalued. So here it's saying undervalued for the optimistic case because 473 is greater than 381, and then the conservative and base case are considered to be overvalued because they're simply below the current stock price. There's also a chart here that compares the buy price, or you can also change this to the implied share price if you want to ignore the margin of safety, and this compares the stock price. You can also toggle between conservative, base, and your optimistic case scenarios here to get a better idea of the gap between the price to pay versus what the company is currently trading at. And then finally, you have these two sensitivity tables. The first table is a table comparing the discount rate versus the perpetual growth rate. And this table here only applies if you're using the perpetual growth rate method for terminal value, since there is no perpetual growth rate for the exit multiple method. And it shows buy prices over different combinations, so you can see how sensitive valuation is to changes in either input. So you type in the perpetual growth rate here, just 2%. 10% is based on the discount rate you type in here. And then here is where you type in the delta change you want to see between each increment. And you'll see more sensitivity tables, and they all function the same way throughout the entire workbook. You can also select between comparing against the conservative base or optimistic case buy prices. These tables do not calculate themselves unless you have calculations set to automatic, which I would recommend not doing since that slows down the workbook. Instead, what I would recommend doing is going to formulas and then clicking on the calculate sheet button here, and it'll calculate the data table for you and update the chart's values as well. These waterfall charts are worth looking at because they isolate the dollar impact of changing each variable independently from the base case. The second table here is self-explanatory. It's just a discount rate versus the margin of safety. Same format, same waterfall chart structure. This one is useful for seeing how your buy price changes as you adjust your required margin of safety at different discount rates. And that is how you can use our discounted cash flow template to value companies. The next tab is the dividend discount model, or DDM tab, and it features 4 dividend discount models, each suited to different types of dividend paying companies and expected dividend growth patterns. So they all share the same structure. We have the formula inputs at the top here. Sometimes we have an optional formula input section here. Otherwise, it's just a part of the formula input section. And then below that, we have the formula output calculations. And then we have the price comparison and valuation. And then we have a warning section just to ensure that the values that you're inputting into the DDM are reasonable. Like the DCF, you also have an identical stock price versus buy price or intrinsic value / implied share price chart here, as well as a sensitivity table. Lastly, all of the dividend discount models share one or more of these tables that show you how the dividend and earnings per share is expected to grow over the next 10 plus years, as well as one more charts that build on those tables to give you a visual of what that would look like. Now, before I go through each model individually, the discount rate across all 4 of the dividend discount models defaults to the CAPM cost of equity, where you would just input in the beta here and the equities premium, and it would give you a simplified CAPM here. You could also input in your own personal required rate of return, or you could use equals CAPM to just reference the CAPM from the WACC tab, or the modified CAPM to reference that version as well. The main thing to pay attention to here is that unlike the discounted cash flow, where you might use the WACC for discounting on lower future cash flows, dividends are cash flows to equity holders, so you should always be using an equity discount rate here. So let's start with the Gordon growth model, which is the simplest model. It just assumes that dividends grow at a constant rate forever. We're just going to input 10% for all of our discount rates to keep things simple. And then in the formula input section, you would select your analysis here, which should just be the analysis here you input on the overview tab. So that's recent. You could then choose whether to calculate dividends using actual dividends per share or earnings per share times the payout ratio, which is another way to calculate dividends per share. This is more relevant for the more complex dividend discount models. In our case, just keep it on dividends per share. And then here's where you select the discount rate method. You can choose between the CAPM, or you select the personal required rate of return, which is what we're doing, the 10%. Lastly, you'd input it in the perpetual dividends per share and earnings per share growth rate. So this growth rate would grow into perpetuity. This is where the dividend growth analysis tab comes into play, since this is where you'd analyze the historical dividend growth and sustainable growth rate patterns to inform this assumption. In our case, case, we're just going to keep that at 2%. The key constraint here is that the growth rate, as we mentioned on the discounted cash flow for the perpetual growth method, is that it should be below the nominal growth rate of the economy, the 10-year risk rate as a proxy for that. If it doesn't, the model, like the DCF, will flag it in the warning section here. And again, the discount rate should be greater than the perpetual growth rate. I also have these other supplementary ones. So the first one is saying that beta should be less than or equal to 1.5. That's an arbitrary one, but it's useful because if you're valuing a company that's going to grow its dividends into perpetuity at a sustainable 2% rate, then more than likely the company's beta would not be greater than 1.5. If it is, then you probably should not be using a dividend discount model for that company. Earnings per share here should also be greater than 0 ideally, since we're assuming the company is effectively at a normalized state and is going to continue to grow its earnings per share, which should be positive at a stable rate into perpetuity. The next one here, dividend pay ratio should be greater than 20%. This one is saying no right now because we don't have these optional formula inputs section here completed, which we'll talk about later. The idea here is that if a company is not paying out about more than 20% of its earnings as dividends, then you may be better suited to using a discounted cash flow or another valuation approach, since dividends don't seem to be the primary way the company is returning shareholder value, in which case the dividend discount model's core assumptions fall flat. So that's why the Gordon growth model works best for mature, stable companies with consistent dividend policies and growth rates that aren't really expected to change much. And it's really not super useful for companies with irregular dividends or those still in a high growth phase. And then for the sensitivity table here, just input the perpetual or stable growth rate here. So in our case, that's a 2%, and the discount rate here is 10%. So just input that here and then calculate the table. Now, if you wanted more flexibility, you would move on to the two-stage dividend discount model. And what it does is it splits the forecast into two phases. So you'll see now there's a first stage and a stable stage. The first stage is considered to be the stage of extraordinary growth, followed by a stable growth phase into perpetuity. So this phase is basically the same as the Gordon growth model. So you'd input in the cost of equities here. Typically, the first stage is higher than the stable stage, but these can be reversed. And then you deselect the analysis here again. The number of periods on the first stage can be anywhere from 1 to 10 years, just depending on how long you believe the first stage will last. Again, here is where you select the discount rates you used. So we're using the 10% and 8% here as our assumptions. With a typical setup, you'd have a higher growth rate. So I have 8% here, and then the same 2% perpetual growth rate. You also have a higher return on equity. So here it's just showing you the actual return on equity, so you can use that if you want. And you could assume that becomes lower in a stable stage. And as you can see, that ties to the expected dividend pay ratio by taking 1 minus the expected growth rate divided by the return on equity. So the first stage has a higher growth rate, a higher return on equity, and a higher cost of equity, as we mentioned, and then a lower payout ratio. And then once it reaches a stable stage, that all flips. The point is that the second stage normalizes to lower growth, lower ROE, higher payout, and a lower discount as the company matures, assuming the first stage is that extraordinarily high growth rate. So here is where the formula outputs becomes a little bit more involved, because you can calculate dividends using the actual dividends per share or earnings per share times the dividend pay ratio. And the recommended approach here for the two stage is actually to use the earnings per share times the dividend pay ratio, since it ties dividends directly to earnings and payout assumptions, rather than just projecting dividends per share in isolation, which actually affects the output quite significantly. The limitation is that the transition from the high growth to the stable growth is abrupt, as 1 year you're growing at 8% in our case, and the next year we're growing at 2% into perpetuity. And it's fair to say that's not how most businesses actually evolve. Now, if you inputted everything in here correctly, this warning section follows the premise that you're modeling a dividend discount model that has an extraordinarily high dividend growth in the first stage, followed by a lower dividend growth in your stable stage. So if you do everything right there, then all this should be flagged as green. There are just some additional warnings here because there's more than one discount rate and growth rate and dividend pay ratio. If you wanted a dividend discount model with a more gradual transition, that is where you would navigate to the next model, which is the H model. So this was introduced in 1984 as a modification of the two-stage dividend discount model. So instead of immediate shift, growth declines linearly to the stable rate over the first stage. You can see that here in the chart if you compare the gradual line versus the sharp decline. The key structural difference here is that the discount rate, ROE, and pay ratio all stay constant across both stages, and And the only thing that really changes is the growth rate here, which we have the same as the two-stage dividend scale model. So the setup here is simpler, but that also means that it cannot capture situations where the company's risk profile or payout policy is expected to change alongside its growth, which is where the two-stage dividend scale model was technically better at. So because of how the H model is structured, the recommended dividends per share calculation method here is actually just to keep it at the actual dividends per share rather than earnings per share times the dividend pay ratio. Now, if you want the best of both worlds, you would navigate to the most complex, but also the most technically accurate dividend scale model, which is the three-stage dividend scale model. So the three-stage dividend scale model has an initial extraordinary growth phase, a transition phase where growth declines linearly, and then a final stable phase into perpetuity, as this first chart here effectively illustrates. So each stage gets its own discount rate, ROE, growth rate, and pay ratio. During the transition phase, all of these change linearly from the first stage values to the stable stage values. So we're capturing the full life cycle, and that can be seen in this table, the second table here, where we're assuming that the initial stage is the high growth, then we have a gradual maturation of the business until an eventual steady state, which is just a growing growth model effectively. Again, this is the most realistic of the four models, but it also requires the most inputs because you're setting assumptions across three separate stages, and small changes or errors even can have a meaningful impact on the output. So we have the same inputs here as the two-stage dividend scale model, except we have more than one stage to select from. And like the two-stage dividend scale model, the recommended dividends per share calculation method here is the earnings per share times the dividend pay ratio, since each stage has its own pay ratio and growth rate that need to interact properly. So you can see how this is reflected in the chart, and you can see how the dividend pay ratio is increasing as the company is maturing, and then how the company's discount rate is decreasing as the company is maturing as well. One last thing to mention here is for the multi-stage models, just make sure that the rates you enter in here are referencing the stable stage periods, not the initial stages, since most of the value when valuing anything that grows into perpetuity is going to be most reliant on the stable stage inputs, not the ones in the first stage, which only last up to a certain period. But that is how you can use the dividend scale model to value any company that is expected to pay dividends in the future, and particularly those that have more predictable dividends per share, earnings per share, and payout ratio patterns. Let's move on to Benjamin Graham's Valuations. So this tab gives you 3 valuation approaches based on Benjamin Graham's work. These are simpler and more conservative than the discounted cash flow or the dividend scale model. Graham was focused on finding stocks trading below clearly defensible measures of value with a margin of safety built in. The first approach here is the Graham net, which tries to identify companies trading below liquidation value. So there are 2 versions that are offered within the spreadsheet. The first is the Graham net current asset value, and this just takes the current assets minus the total liabilities minus preferred stock minus any off-balance sheet items. The idea is simply that if a company is shut down today and liquidates its current assets, would there be enough to cover all of the liabilities and still leave something for the shareholders? So you can say the model calculates the net current asset value per share version, the price to net current asset value ratio for each period, and then you can also apply margin of safety if you like, and that would give you a buy price. It works the same as the other valuation models by comparing the buy price to the stock price to determine a valuation label. The other net approach is Graham's net working capital, which takes it a step further by applying liquidation discounts to the current assets. So the approach here is to take cash and short-term investments at full value, but then accounts receivable gets discounted to 75% and inventory to 50%, reflecting the reality that you'll likely take a haircut on those in a liquidation scenario. It then subtracts the same liabilities as the net current asset value, and it has the same output structure with the buy price and overvalued, undervalued labels, and the margin of safety input. So you'll see that the first chart here plots net current asset value and net working capital, the buy prices versus the stock price. The second chart here that we haven't discussed yet is comparing Graham number versus the stock price. So the Graham number is directly below the net section, and that just estimates the maximum price a defensive investor should pay based on the earnings per share and the book value per share. The formula is simply the square root of 22.5 times the diluted earnings per share times the book value per share. That 22.5 comes from Graham's criteria, which is a maximum PE of 15 times a maximum PB or price to book of 1.5x. So the model calculates Graham's number for each period, and then like the other sections, it calculates the price to Graham number ratio, applies the margin of safety, and then outputs a buy price and valuation label by comparing it to the stock price. These criteria checks also test whether the stock even meets Graham's defensive investor standards for each period
period. If it says no, then you should not be using the gram number. It checks if the price to earnings is below 15 and if the price to book is below 1.5x. Both have to pass for the condition to be met, and that is where the data for the gram number versus stock price chart up here comes from. The third and final approach is the gram formula, which is Graham's revised intrinsic value formula. It takes earnings per share. You can select between the basic earnings per share or the diluted earnings per share times a base PE of 8.5 for a no growth company plus a growth factor multiplied by the historical average AAA corporate bond yield of 4.4, and then all of that divided by Y, which is the current AAA corporate bond yield. So it's basically adjusting for the no growth valuation for expected growth and prevailing interest rates. I've already filled this out here for you. You can take this as much as you like, whatever you think is most realistic for the company you're valuing. It calculates the implied share price by just completing this formula, and then you can apply a margin of safety as well, like all the other valuation approaches, and then it calculates the buy price and applies a valuation label. Here is the last sensitivity table in this model. It just compares the AAA corporate bond yield to the expected growth rate, and we have the waterfall charts here as well that isolate the impact of each variable. One final thing to mention from the gram tab is that the price to net current asset value, the price to net working capital, and then also the price to gram number shown here from this tab are carried over to the key financial ratios tab under the price section, which means that you don't have to come back to the gram tab every time you want to reference those. Moving on, we have the comparable company analysis or comps tab, which is a relative valuation model. The idea is simple. Instead of projecting cash flows and discounting them back like the discounted cash flow or dividend discount model, comps estimates what a company should be worth based on how similar companies are being valued by the market right now. The way you use it is you simply start by finding comparable companies that are publicly traded. So you have up to 10 ticker inputs here, and picking the right comps matters a lot here since the whole approach is based on the premise that these companies have similar business models, growth profiles, and risk characteristics. The closer the match, the more meaningful the output. So for our example, let's just go to the overview tab and then copy these same tickers here. Paste them in, you'll see that all the data loads instantly. Let's just add some more so you can see how it works. So let's try adding Meta, Baba, Triple M. Obviously, these aren't really pure comparables to Microsoft, but just to show how the model works. So you'll see the first section here is calendarization. Calendarization is important to do because it standardizes the financial data across companies with different fiscal year ends. So you can see the fiscal year end dates here for 2025, since that's our analysis here. And you can see that the dates obviously vary because it varies from company to company. If one company has a June fiscal year end and another one has a December fiscal year end, their annual numbers are not apples to apples. So if you enable calendarization by just clicking yes here and then selecting the current fiscal year or the one before it, or you can also calendarize the year after the last fiscal year, so the forecast year, then the calendarization will apply across every company in the model for whichever calendarization year you selected. So here's where that data and the math is being done, and it's also being applied across all of these other columns and the calculations. And you can see the years that are being calendarized by this label here in row 13. The ones that say CLD are the ones that are calendarized. So I'd recommend just to keep the calendarization year on. Next, we have the market data section, which shows you the current stock price, the 52-week range position with conditional formatting relative to how high it is compared to its 52-week high. We also have the share counts, market cap, and enterprise value for each company. You can select between the trailing 10 months of the last fiscal year or the year before it for all of these figures here, just using these drop-down cells. Next, we have this financial metrics section, which pulls in revenues, EBITDA, and net income for the target company and all the comps across the last few fiscal years, along with analyst estimates for the next 2 years. So all this data is based on Wisesheets. And for these estimates, you can toggle between the low, high, or average, and it'll update for you. The next section is the trading ratios. So this shows the revenue growth, the EBITDA margin, and then the profit or net income margin across the target company and all of these comparables. So these are all conditionally formatted so that higher values show green and lower values show red. And this gives you a quick visual on where the target stands operationally relative to its peers. Finally, we have the trading multiples, which show enterprise value to revenue, enterprise value to EBITDA, and the price earnings ratio. So here the formatting is the opposite of the trading ratio section because lower multiples are preferred. So green is applied for lower multiples and then red format is applied for higher multiples. And in this section here that I've highlighted is a percentile distribution section, and it calculates the max, 75th percentile, mean, median, 25th percentile, and the minimum. So this gives you the range you'll use used to derive the implied valuation for the historical and forward implied valuations. So that is what is being pulled into, these tables here, just depending on the valuation years you select in these drop-down cells. If you start with the historical implied valuation, this uses the company's actual reported financials. So you start by selecting the analysis year here or the preceding year, and the model takes the multiples from the percentile distribution, applies them to the target company's financial metrics. So the revenue, EBITDA, or diluted earnings per share or basic earnings per share. And then this calculates the company's implied enterprise values, which is not really a thing for net income. For revenue and EBITDA, it then bridges to implied equity value by adding cash and short-term investments and then subtracting total debt and minority interest. You can always toggle between basic and diluted earnings per share. And then you can also switch between trailing 12 months, last fiscal year, or the preceding year. So here's how the net income equity value is calculated. It's just taking the earnings per share, multiply it by the diluted shares, and then multiplying that by the price to earnings ratio. The final part is just dividing these implied equity values by whatever share count you give the model here, and that determines the buy price range here. Forward implied valuation works the same way, but it uses analyst estimates for the next 2 forecast years instead of reported numbers. The main difference is you select between the low, high, or average earnings per share estimate, and then you can input your own assumptions for the non-operating assets and the non-interest bearing liabilities. I just referenced the historical values. The calculation otherwise is the exact same as the historical implied valuation. In both cases, the mean and median are typically the most reliable indicators of where the company should be trading based on its comps. And if the implied share price is above the current stock price, the stock looks undervalued relative to the peers. If below or overvalued, you can use this drop down yes no here to conditionally format when the stock price is lower than or greater than the current stock price, which in our case for Microsoft is the 380. One final thing to note here is that if you enable calendarization, the valuation year you select here should match the calendarization year at the top here, just to keep everything consistent with how you're interpreting the valuation. The final valuation tab is the residual earnings valuation tab, or REV tab. It takes a different approach to valuation because instead of projecting cash flows or comparing multiples, it starts with what we already know from the financial statements, and then it asks how much extra value, if any, the company is creating on top of that. This is based on Stefan Penman's residual earnings framework. The core idea is that if a company earns a return on equity above what shareholders require, it is creating value. If it's below, then it's destroying value. That difference is simply referred to as residual earnings. So the model is relatively straightforward. It uses 3 years of actual data for the basic earnings per share, dividends per share, book value per share, and the return on equity. And then it forecasts 2 years out where you'd input in your own earnings per share and dividends per share estimates. You'd also input in a discount rate and a residual earnings growth rate. So in our case, I just used 4% here because that's about roughly equal to the risk-free rate. So the valuation formula starts with the current book value per share as the present value of the near-term residual earnings over the next 2 years. Then it adds a continuing value for residual earnings beyond that horizon. So you're anchoring on something concrete, which is book value, and then layering on what the company is expected to earn above its cost of equity, which is the discount rate here, in the near term, rather than speculating about cash flows 10 years out like you're doing for the DCF. Below the main valuation, you have a no growth valuation section, and this calculates what the stock would be worth if the company generated 0 residual earnings growth going forward. So there are 3 versions provided: the current year, the 1 year out, and the 2 years out. And the gap between the actual stock price and the no growth value tells you how much of the current price is being driven by the residual earning growth expectations. So this feeds into the stock price decomposition, which is shown in this waterfall chart. It breaks the stock down into 3 components. Firstly, book value, which is what the accounting statements say the company is worth. Then we have the short-term accounting value, which is the near-term value added from the forecasted residual earnings. And then we have the long-term growth value, which is what the market is paying for growth beyond the forecast horizon. This last piece is the speculative component. This drop down here lets you toggle toggle between the current 1 year and 2 year views. And this is a really useful way to see how much of the stock price is grounded in fundamentals versus how much is a bet on the future. At the bottom, there's also an implied growth rate analysis. This effectively reverse engineers the residual earnings growth rate that the market is implying at various stock price levels. In this cell here, you can adjust via a price step input. In our case, at 15%, but for each price level, if you change this, it'll show you the no growth value, the value attributable to growth as a percentage of the stock price, and the implied growth rate. So this is useful for flipping the question around, and instead of asking what the stock is worth at the current price, which is the 381 right now, you're asking what growth rate the market is baking in at the current price and whether that's reasonable given what you know about the business. So that is the full spreadsheet. You've got the key financial statements and key financial ratios tab, giving you the financial foundation charts to visualize all of it. And then the valuations with owner's earnings, free cash flow of the firm, forecasting, WACC, and dividend growth analysis to help inform the valuation models. Then the DCF, DDM, gram, comps, and residual earnings value are very flexible models that you can configure easily the moment you start typing in a ticker into the overview tab here. Now, if you want a deeper explanation on anything we covered in this video, especially the valuation models, which can be a bit complex. Every single valuation model and the valuation inputs here, as well as how to read and interpret financial statements, are described on the StableBread website. We have 151 articles at the time of producing this video that are completely free to use, and most of them have Excel models, step-by-step examples included within them. And also you'll have access to the documentation if you download any of the versions, and you'll have more detailed instructions and guides there as well to help supplement your analysis process and to help you understand how to use the spreadsheet to the most of its capabilities. Hopefully you found that video helpful, and if you have any questions or suggestions for the model, please let me know.